Good morning, and welcome to Startup University. We have a very distinguished panel today. My name is Emily Tan. I'm the Global Technology Editor of Campaign. And we have Howard Morgan, co-founder and special advisor of VC firm First Round Capital and chairman of B Capital Group. And then we have with him Kathryn Petralia, co-founder and president at financial services company Kabbage. Now, the goal of this panel, managing the investor-founder relationship, is going to try and help you figure out how best to not just choose investment for the amount of money you can get, but for a long-term and successful partnership. Perhaps we could start out with Kathryn to talk about perhaps some of the common mistakes that startups make when they go around looking for investment in the very initial stages of it.
I think it's very important when you're looking for an investor to try to find somebody whose long-term interests are aligned with yours. So it's one thing to find a company that's also invested in, and we're in fintech, has invested in fintech or small business lending because they do have expertise there. But you want to find investors that also believe in the long-term vision, believe in the growth of a technology company, believe in the opportunity to grow globally. They're not just focused on, a quick investment and a quick exit if you want to grow your company. If you want to have a quick exit, then find an investor that wants to do that.
And Howard, what advice would you have as a VC fund for companies that want to pitch you? Like, what kind of companies what should they look for in a fund before they pitch them? Let's put it that way.
Well, we tell companies they should look at the partners, look at the investments we're already in, to see if we do, as Kathryn said, have expertise in the field that they're going into, and also to see that we don't have a competitive company, because we don't like to have directly competitive companies. And then they should try to understand whether we, as a firm, the firm looks like one that has helped companies in that area over the long term, that likes long term, because we're not looking for quick flips. We invest at the very early stage. We expect to have a 5 to 10 year relationship with the company.
So you're not looking for founders that just want to get a quick exit and move on to the next thing. You want ones that are interested in building the business long term.
Quick exits are not good for the fund. I mean, quick exits are usually at too low a price. And while they may be interesting to some founders, particularly first-time founders, they're not what makes a fund return what it needs to return to its investors.
So Kathryn, you yourself went through a round of funding for Kabbage. Could you tell us, give us some insights from the process and how you chose the funds you approached and perhaps the success story that came out of it?
So we just closed our Series F a couple of months ago, which means we've spent most of our time over the last 8 years on the road raising money. So that's been interesting, and it really has changed over time. Raising money for our seed round was an incredibly different process than raising $250 million from SoftBank. So I would say that it really depends on what stage you are in your business, the way you approach it. I think the entire time what's been really important is trying to make sure that we could not only explain what we were doing, but also paint the vision for where we wanted to go in the future, to find that right investor that was seeking it, and to demonstrate that we understood what the future of the company was. And I think that's very important. But you really have to be prepared. You have to have all your ducks in a row. You have to have all the data. You have to make sure that when they dig in, what they're going to find supports the story that you told them up front. So you can't, smoke and mirrors is really hard when you're talking to professional investors, because they know what they're doing and they know what to look for.
You mentioned your Series F now, so could you cast your mind back to Series A and think about the things that you wish you could tell yourself back then when you were looking for your Series A funding?
It's interesting. We were raising money in 2010 for a financial services, a lending business. That was not the best time to be doing that, just after the global financial crisis. So you would think I would say to myself, oh, why don't you wait a few years and do that later when it's a lot easier. But it actually was really a great experience. And the nice thing was it allowed us to sort of start in a counter cycle, which has turned out to be advantageous to us long term. But honestly, we did all the things that you need to do back then. Gosh, I guess what I would say is maybe I wish I would have taken a little bit more to heart some of the criticisms that some of the investors who didn't invest had. We tried to be good about listening to their objections and trying to formulate our responses to them and understand how important that was to our future business. We probably could have done more of that. And I think we might have avoided some of the mistakes we made along the way.
So I understand a fund that passed up on investing in you is Howard's.
right here.
Yes, we did. We did. So we had invested in On Deck Capital a few years before, and On Deck was doing peer-to-peer lending for businesses, but we were a little worried that it could get competitive with Kabbage. In addition, one of the things a lot of VCs are focused on is geography, and while we're not very focused on it at first round, Kabbage was in a geography in Atlanta, which is not a typical place for us to have invested, based in New York, Philadelphia, and San Francisco. So that combination caused us to make one of our big mistakes, which we did, because they built a great company.
Thank you.
But at the same time as well, it is a case of managing your portfolio as well. So even though you have invested in a company similar to one that's, say, pitching you now, it's not a guarantee that the company pitching you now will automatically get investment from you as well, because it depends on how you want to manage your portfolio. Is that correct?
Well, yes, but we don't invest in direct competitors. We don't think that's fair to the company, because there's too much information leakage. Even though we're very good about compartmentalizing when we need to, and occasionally companies that we've invested in that were very different will pivot and start aiming at the same place. But we prefer to be in companies that are not competitive with one another.
I understand you also passed on Twitter.
We also passed on Twitter very famously. We had been in Odeo, which was the previous company to Twitter. But when Twitter came to us, the valuation was too high. We thought it was $20 million. At that time, we limited ourselves to a $10 million pre-money valuation. After noticing the mistake we made at Twitter, we did Square at a higher valuation and did very well with that. So we've changed some of those rules.
So let's talk about perhaps some of the softer side of the investor and startup founder relationship. Chemistry. Besides the hard business case of whether you're a match as business partners, what about just personality? Is this important? Is this something that people need to think about, or are everybody professional? So?
It's very important. I'm going to be involved with a company for a decade after we make the investment, and if I can't feel comfortable talking to them completely straight about everything and enjoy their company, because at first round we do a lot of dinners and salons and breakfasts, and we have a community of events. Life's too short. There are a lot of investments out there. We look at 5,000 a year, and we do 40. So my job mainly saying no, and so the saying yes is really a question of what we think is a great entrepreneur, or set of entrepreneurs. We prefer teams, a great market, and good chemistry with the people.
So Kathryn, what about you? In terms of how do you look for chemistry with them, and perhaps what characteristics should people be aware of when it comes to venture capitalists?
I would say chemistry has always been very important to us. And I think it's more important early stage, because those investors are very involved with your company for a really long time. And it's a smaller team that you have, so they're technically joining your team, and they should be an important part of that team. So culture is incredibly important. One of the things that we did that I think I would advise anyone to do is we would actually contact companies in which those folks had invested previously that had gone through tough times. And the reason we wanted to do that was to find out how did they react when something negative happened, which it invariably will. And it's important to know, are you dealing with somebody who is early on in their career and they may have an outsized reaction to something negative that happens, or are you dealing with somebody with a lot of experience who is going to know how to help you get through some sort of turbulent event? So that was really important. But what we joked all the time, we really feel like, especially our early investors, one of the reasons they invested in us is because they enjoy the chemistry too. It's really important to be yourselves. It's really important to have fun, and it's really important to make sure that that culture fit is aligned with your investor.
So you made it. You're a startup founder, and you've got your Series A funding or B, and what are the next steps that you should take, before to establish a relationship so that it's a profitable one in the long term? After you withdraw all the cash, put it in a big pile, and then jump into it, which obviously what we all want to do secretly.
Well, for us, one of the things that's critical is transparency. Overload the investor with information. We much prefer more information to less information, and we want to know when things are going right and when things aren't going right, so we can help. What investors hate most is surprises. in negative or even positive. I mean, obviously positive surprises can be fun, but you really don't want to be surprised. So that means good communication is the most critical thing.
It's not so much about what they've done, but the fact that you feel you can trust them to communicate clearly with you, and you know that they are doing what they say they're doing.
Yes.
It's about building a relationship of trust. And what did you learn about working with your investors after you've received funding?
I think we got some really great advice from another company that didn't invest, Google, when we were raising our Series A. And he said, after you raise your round, it's really important that you go ahead and build your next deck for your next round of financing, not because you're going to go out and raise money right away, but because it really helps you articulate your vision. And that allows you to use that as context with your recent investor to talk about what are the decisions that you're making that are going to lead you forward, so that everybody is in alignment on exactly where you're going. That transparency is very critical. Rob, my co-founder, and our CEO is sitting right over there. He has been more responsible for managing the board, and he is incredibly transparent anytime anything happens. And it's for two reasons. One is you want to make sure that you have trust, but also theoretically and hopefully in practice, your board can help you make decisions and help you navigate, tough waters.
What are the rookie mistakes you see from new founders who have just received funding? Like, what is the natural tendency to do that people should just kind of avoid?
Well, the natural tendency is not to ask for help, and because founders want to prove that they can do it themselves, and they can do most of it, but the best founders are the ones who say, for example, because we invest at the very early stage, what should the board deck look like? What do I need to, so one of the things that First Round has done with its community is put up a set of sample board decks for the community. What does a board deck look like for a SaaS company, for an enterprise software company, for a consumer company? But give a sense of defining with us your KPIs, your key performance indicators, so that we can agree on which way, and then, as Kathryn said, then start thinking about where you want those to be over 6 months, 12 months, 24 months, and where you want the company to be.
All right. Well, let's talk about what happens if you've been passed up by the VCs. As you said, there are learnings to take away from that as well. Let's say it's easy to take a decision not to invest in your company very personally when you're a founder, right? What advice do you have for people who have just been rejected?
We have been rejected so many times. It's incredible. Early on, you get offended. You're like, this is my child, and I really care about this, and they're saying that it's a terrible baby. And anyway, so I think it's important to just move on from that, and to take the feedback, to ask the questions. We got really good about asking the question when we would get a rejection. What is the one thing that if we changed would make you more interested in this business? The other thing we would say is, can you give us a referral? Because nobody likes to say no. They want to be helpful, and maybe it's just not in their mandate to invest in your type of company, but they know other people who may want to do that. People want to be helpful. So that's another piece of advice I would give. The last thing I would say is, for the same round, don't go back to the same investor unless there's an obvious reason why you would do so, because they already said no. They don't want to say no twice. But you can go back to them in the future if you're raising another round. It's important to maintain those relationships because you never know when it's going to be a good fit. So a scorched earth plan doesn't really work well when you're raising money. You need to maintain relationships. And we have investors who we've talked to over 3 and 4 rounds who have turned us down in every one of those rounds, but we go back to them anyway. And we actually like these people, and we have great relationships with them.
All right. So, as an investor, how do you feel about startups coming round again to you?
Well, I think first of all, as I said, since we turned down 99%, our goal is to do it in a way that's helpful to the startup, so that they'll come to us with their next startup if in fact this one doesn't succeed. Because we only invest at the early stage, we're usually not there in their next round, so it's harder for them to come back to us with their next round. But it is easy for them to come back to us with their next idea if that happens, if they're either successful or unsuccessful in their previous company, because we've developed a relationship and we've hopefully given them some useful feedback along the way as to why we didn't invest in that particular venture. But I do advise, as Kathryn says, you don't want a scorched earth policy in either direction. I mean, as investors, we don't want companies to hate us and to badmouth us to the rest of the industry. But we also think it's important that for us, we want founders to send their friends to us.
What is the classiest response to rejection that you've ever seen?
The classiest response? We've gotten a lot of handwritten notes. They usually come right at the point that they've raised the round, and they said, we're sorry you didn't see how to do this, but we appreciate the advice you gave us along the way, and now we have closed.
So we have 2 minutes, and I realized that I actually missed a very crucial part of this discussion. How do you even get an audience with a investor in the first place?
How do you what?
How do you get an audience with an investor? How do you get that pitch?
Well, at first round, we give you the usual advice if you go to our website, which says find a warm introduction. Find somebody who knows one of the partners and have that person make the introduction, because you're much more likely to have us take a detailed look. We look at everything that comes through the top of the funnel, but most of it is very quick. If we don't know you, if we don't have somebody who's vouched for you, it's very rare that we would end up doing the deal or bringing you in for much further diligence.
And what about you, Kathryn? What were some of the ways that you got into a pitch, or are there things that perhaps are not so obvious that people should be aware of, opportunities that they can grasp?
I think it's important to understand how many pitches these folks receive. I mean, they are receiving, for every investment they make, they look at thousands of pitches in some cases. So you need to realize that just sending an email isn't going to be enough. Just submitting something on the website isn't going to be enough. The warm introduction is very important. I am thinking through every one of our rounds. In every single case, every single institutional round we raise, we were introduced to the investor by someone we knew. So that networking component is really important. Ron Conway also gave us some really interesting information. They were an early investor in Kabbage as well. And Ron told us that entrepreneurs go up to him all the time and give him cards, and he gives them cards. Most of them never sent him a note. He said, it's crazy that they don't take advantage of that opportunity to email me directly and ask me for another audience and give me the pitch. They simply just don't ask the question, and it's really important to follow up.
So why do they bother? I mean, why do they get his card and give him their card? And do they just get cold feet afterwards?
Well, some of them are afraid there. The other thing I would say is be very careful with your pitch deck. The worst thing that we see is somebody who comes in with a pitch deck and reads it to us, because we can actually read very quickly. So, when the slide goes up on the screen. So we want to be able to have you talk through things. The best pitch decks are much more visual than they are textual, and then you speak about them.
So don't take this personally, but we actually took our deck and turned it into a cartoon story for our Series A, and miraculously, we raised money on that.
Yep.
So we're out of time. Right. Well, thanks very much. I think if the audience has any questions, they can look for you on the app. And it's great having you. Thank you. Thank you, everyone.
Thank you.
Oh.